Hello, everyone, and welcome. My name is Elliot Gu, and this is our special webinar strategy session that we've titled What to Make of Current Stock Market Valuations. I'm going to get started here in just a minute, but I see a number of participants are still logging in, so I'll just go ahead and start off with some housekeeping notes. First up, this webinar is being recorded, and we will send a link out to the full webinar recording, as well as a link that will allow you to download a PDF version of the slides that I'll be presenting to you today. Probably tomorrow morning, or maybe even later on tonight. You'll have a link to both the recording as well as the slide deck. I am going to be opening up this webinar to a question and answer session. I'm going to wait until after my prepared remarks to answer any questions. But if you'd like to ask a question, you can do so at any time by clicking the Q&A box on your screen and typing in your question. Or you can use the chat box if you prefer, and just type in your question and post it there. And I will get to all the questions I can shortly following the conclusion of today's webinar. I'm going to be going through about 15 slides in terms of prepared remarks, including some macro a picture for the US, as well as the stock market, as well as some specific names that we like and specific names that we don't like right now. The website that you see on your screen there, https deepdiveinvesting.com /hidden in plain sight chart. If you go to that website, you'll find that some of the information, the charts, and the trends that I'll be discussing in this webinar are there. It's a fairly lengthy report we posted to the web pretty recently. So some of the things I'll be talking about today are posted to that website, but not everything. And some of the things that are on that website I will be talking about on the webinar, and some things I won't be due to time constraints. So what I'm saying is this webinar and that website are complementary, not substitutes for one another. So with that, hopefully everyone can hear me and see the slides well enough. And again, just for those of you who just logged on, it is being recorded, and I will send a link to the recording as well as the slide deck shortly following today's presentation, probably first thing in the morning, tomorrow morning on Friday the 14th. So again, if you'd like to ask a question at any time, type it into the chat box or the Q&A box, and I'll answer them all shortly following the conclusion of my prepared remarks. So let's go ahead and get started. It's just a couple of minutes after 2 o'clock here on the East Coast. I do have a tendency to run long on these things, so let's go ahead and get started so we have plenty of time to go through all of the questions at the end. First of all, we've been hearing a lot about the length of the current bull market. A couple of weeks ago on, I believe it was Wednesday, August 23rd, this bull market, as measured by the length of the rally in the stock market without a 20% or greater correction in the S&P 500. So in other words, the S&P 500 has seen corrections. In fact, one correction of around 19% in late 2015, early 2016. But the sort of unofficial definition of a bear market is a 20% or greater correction. And the current rally is the longest in history, the longest in US stock market history, uninterrupted by a 20% or greater correction. We've seen the rally last 3,475 days as of today, September 13th. So it's the longest rally in history. On August 23rd, it surpassed the rally of the 1990s from October 1990 up through March 2000 in terms of length. And I've put a number of the historic rallies in the stock market, the longest historic rallies in the stock market going back to the 1930s. And you can see that this rally and the rally from 1990 to 2000 are head and shoulders longer than any prior rally we'd seen in the S&P 500. So naturally, because it's such a long rally, such a long bull market for the S&P 500, you're probably, I know I am, seeing and reading a lot on the internet, on financial television, etc., talking about when is it going to end? We know it's the longest in history, but when is it going to end? Is it about to end because it's so long? We've also seen a lot of talk about a bear market or recession lately. And this is just a slide I actually put together this morning, looking at some of the things that I've read just over the last week. Just earlier this week, Goldman Sachs, their chief strategist, David Kostin, you've probably seen him on TV, he called for a bear market under a scenario where the US imposed 10% tariffs on all of its imports. He has a lot of concerns. If you listen to some of the interviews he's given lately, he has a lot of concerns of a trade war between the US and China kind of snowballing and bringing the US economy to its proverbial knees and causing a bear market in stocks. Morgan Stanley recently, I believe on Monday, recommended reducing positions in US equities, saying that returns were not going to be as great for the stock market going forward as they have been over the last few years. JP Morgan recently did a study of 7,000 earnings transcripts for US companies, and I believe North American companies, Canadian companies as well, going back for the last quarter, second quarter, calendar second quarter earnings transcripts. And they found that 35%, so more than a third of the companies that they analyzed, cited trade and tariffs as a threat to their business last quarter. In fact, trade and tariffs were more often cited than the positive benefits of tax cuts. So their view is that trade is a real concern, kind of echoing some of the same sentiments as the Goldman Sachs strategist I quoted there. Just yesterday, hedge fund manager Ray Dalio, you may be familiar with him. He runs a hedge fund called Bridgewater Associates. It was one of only a handful of hedge funds that actually had positive returns back in 2008, a decade ago, which of course was a terrible year for the stock market. It's the largest hedge fund in the US, and in fact, the largest hedge fund in the world right now. And he says that he sees the US economy entering a downturn in 2020 as the impact of the tax cuts that were put into place at the beginning of this year begin to fade. So we're seeing some sort of a tailwind from tax cuts, and he sees that beginning to fade by 2020. And he feels that the deficit, the amount of government debt in the US is going to be so high that the government's going to effectively be forced to print money to fund the deficit. So that's his big concern. Former Fed Chair Ben Bernanke, you might have even heard him speak, I believe about a week and a half ago, about the Wile E. Coyote moment. Those of you who may be familiar with the Roadrunner cartoon know that Wile E. Coyote used to run along and run directly off a cliff, and he would kind of keep running along in midair for a period of time until he realized what was happening, and then he would fall down into the canyon. So he called it the Wile E. Coyote moment in 2020, when the US economy simply runs out of cliff, right? And as the fading impact of tax cuts, as well as all the stimulus, the monetary stimulus the Fed has provided over the last 10 years since the last downturn, begins to fade. And Societe Generale, they also, I think it was on Friday, came out predicting a rising risk of recession in 2020 due to labor market tightness. So in other words, the unemployment rate getting so low that it begins to prompt inflation and therefore rising interest rates in the US, which in turn cause rising debt service costs, both for the US government as well as fairly leveraged companies that are out there. So this is just a sampling of some of the commentary that I've found in my news feed on Bloomberg just over the last week or so. These were all stories that gained prominent attention, and in fact, you're hearing a lot of people talk about the next bear market and recession. And I believe that the talk about this has actually perked up a lot since the rally officially became the longest in history back at the end of August. Now, I'll say that I do agree with some of the sentiments that are being talked about here on this slide, but not all. And I'm going to talk to you a little bit in a minute why I'm actually pretty bullish on the stock market over the next 18 months or so, maybe even a little longer than that. And I think that a lot of investors out there are making a critical mistake, a common but critical mistake, by focusing too much on these headlines, excuse me, and not focusing enough on the cyclical factors. And I believe throughout my career, I've certainly followed this, that cycles are really the key to understanding a lot about the markets, not only the US stock market, the US economy, but also energy, oil prices, excuse me, commodity prices, etc. And so I'm going to be talking a little bit about the importance of the cycle and how it fits with some of these longer term comments that you're seeing here. You also may have heard a lot that the stock market's expensive, and I believe that's quite true. This is a chart that covers what's known as the CAPE ratio. So many of you may be familiar with Robert Shiller, who's a professor at Yale University, and he wrote a book. It's been a while now, maybe 15 years ago. He wrote a book called Irrational Exuberance. You can find it on Amazon. It's quite a good book, actually, where he talked about long-term stock market valuations. And he wanted to develop a ratio to be able to compare stock market valuations in the United States between different time periods. So just to explain that, price to earnings ratio is a very commonly quoted valuation metric, but it suffers from a major problem, which is that corporate profits and the earnings for the S&P 500 are going to be inflated during stock market booms and during economic booms. For example, earnings became very inflated towards the end of the 1990s because tech companies within the S&P 500 had very high earnings, very high profits in many cases, companies like Cisco, et cetera, towards the end of that boom period because companies were ordering a ton of equipment back then, if you remember. Similarly, in 2005, 2006, a lot of companies with exposure to the housing market also saw inflated earnings, also the financial markets, inflated earnings due to the housing boom. So that artificially pushed up earnings for the S&P 500, which of course made the S&P 500 look cheaper. Similarly, when there's an economic downturn, a recession or worse, earnings for the S&P 500 are going to be artificially depressed, if you will. Depressed, not artificially, but due to cyclical factors rather than longer term trends. So what we're definitely seeing is that you want to be able to adjust earnings for the S&P 500 depending on these cyclical factors. So that is exactly what Robert Shiller does with this CAPE ratio. CAPE stands for cyclically adjusted price to earnings ratio. Instead of just looking at earnings for the S&P 500 over the last 12 months or earnings forecast for the next 12 months, he looks at earnings for the S&P 500 over the last 10 years, which will include 10-year periods, usually include an economic boom and an economic bust. And he adjusts them for inflation as well. So this means that you can compare this cyclically adjusted earnings number and this cyclically adjusted price to earnings number, valuation metric, across time periods. It doesn't matter whether the US is in an economic boom or a bust. It doesn't matter whether we're in a low inflation environment, such as we've seen generally over the last 10 years, or a super high inflationary environment, such as we saw, for example, back in the 70s. So it doesn't really matter what the economic backdrop is. This gives you a more stable measure of S&P 500 valuations. And what he found is he was able to create this metric going all the way back to the late 1800s. I believe we have data. He has data on his website going back to January of 1881, so a long time. And he was able to find that long-term stock market returns correlate very well with this metric. And simply put, as you might expect, when you buy the stock market at a very high valuation as measured by the CAPE, the cyclically adjusted price to earnings ratio, when you buy the stock market at a high valuation, your expected returns over the subsequent 10-year period are very low. When you buy the stock market at a low CAPE ratio, your expected returns over the next 10 years are very high. Now, the average over this time period is somewhere around 11%, 11 to 12%. So when the stock market is cheaper than normal, cheaper than average, you generally can expect long-term returns to be much higher than average. When the stock market is very expensive, you can expect returns to be much lower than average. And all I did here is went back and I looked at data over the last 90 years, so almost a century. And I plotted each one of those blue dots you see on this chart is the CAPE ratio, the cyclically adjusted price to earnings ratio, at the beginning of a particular 10-year holding period. And this is all based on monthly data. And on the horizontal axis there, I've plotted the 10-year annualized return. So in other words, let's say that in January 1970, the CAPE ratio was 15, and the subsequent 10-year return from the stock market was 10% annualized. That would be one blue dot on this chart. The red line that you see that I've plotted over the data is simply a trend line that I plotted using a very standard statistical technique called ordinary least squares. And it is basically a model of stock market returns based on this data, long-term stock market returns. And what you can see here is, you see that number I've circled there, the R-squared ratio, which is 0.703. That actually means that this data alone explains about 70.32% of long-term stock market returns. That's a pretty amazing statistic. I can tell you from having studied the financial markets now for over 20 years, using various statistical measures, various econometric measures we call them, that it's very rare to find any indicator or any metric that correlates to long-term stock market returns anything close to accounting for an R-squared value of 70.3%. Typically, you're lucky to find R-squareds in the 20 to 25% range, which just simply means that the stock market's a very complicated thing. Stock market returns are very complicated things to estimate. The level of stock market is very complex to estimate, and there is no one single factor that can account for all of what happens in the stock market. Valuations are as close as you can come when it comes to, and this is crucial, long-term stock market returns. I'm not talking about stock market returns over 1 or 2 years, because there are plenty of examples where the stock market's been very, 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 very expensive, but has still seen positive returns over the subsequent 12, 24, or 36 months. The late 1990s, for example, the stock market became very, very expensive. The CAPE ratio exceeded 30 for a couple of years there, which you can see is near the high end of this 90 years of data. Yet the stock market over 1 and 2 and 3 year holding periods in the late 90s produced very high returns, among the highest returns ever recorded in US financial history. So valuations are terrible for short-term market timing, but very, very good for long-term returns. In other words, they can't tell you where the stock market's going to go a year from now, 2 years from now, or even 3 years from now. But they can give you a very good idea of the returns you can expect from holding equities over the subsequent 10, 15, or 20 years. And right now, I can tell you, and that's what I've pointed out here on this chart, just this spring, the stock market hit a CAPE ratio of 33.3 times. We've only seen a CAPE ratio higher than 33 on a few occasions in US financial history. One of them was the late 1920s, 1929, which of course, right before the big stock market crash that ushered in the Great Depression of the 1930s, where the CAPE ratio got up to around 30. It actually never exceeded 30, but it got close. And again, in the late 1990s, during the boom and bust of the NASDAQ and technology sector, where the CAPE ratio actually got up even higher than this. It even got up over 40 temporarily. Those are the only 2 periods in stock market history where the S&P 500 has been this expensive on the cyclically adjusted price to earnings basis. And if you think about that, that's pretty scary, right? Because buying the stocks in 1929 would have been a terrible thing. You would not have broken even on that investment until the 1940s, even broken even. And the same thing in the 1990s. It took a long time for the stock market to regain its 2000 peaks. The NASDAQ didn't even regain its 2000 peaks until 15 plus years later. So valuations are very high right now. They're actually higher than in 97.7% of all months since January 1881. on this basis. So stock market's very expensive right now. Looking at the trend line that I've plotted here, it implies that your expected returns over the next 10 years are around 1/4% per year. 1/4% annualized, not total over the time period, but that's only about 2.5 or 3% in total over the next 10 years, which is way, way, way under the long-term average of 11 to 12% annualized. So stock market valuations are a concern, but they're a long-term concern, not a short-term concern. The stock market often produces some of its highest gains, and this is very important to remember. The stock market often produces some of its highest gains over 1 and 2 year periods when it's when it's extremely expensive on this basis. But it does tell you that probably over the next 10 years or so, there's going to be yet another stock market dislocation. And much like we saw maybe in 2007 to 2009 or back in 1999, 2000, 2001, there's going to be something bad that happens. There's going to be a bear market over the next 10 years. And that's going to mean that the long-term returns are not going to be great from buying at the current level. Short term, it tells you very little. Another concern you've probably heard voiced a lot. Several Fed governors have certainly talked about it. I've seen it talked about quite a bit on financial news, financial television. I've seen it written a lot about online, but the slope of the yield curve, I apologize, it's a little esoteric, but the slope of the yield curve just means, in this case, the difference in yield between a 10-year US government bond and a 2-year US government bond. So in other words, if the yield on a 10-year bond is 3%, and the yield on a 2-year US government bond is 2%, which those are not the real numbers right now. I'll talk a little bit more about that in a minute. But then the slope of the yield curve on this basis would be 100 basis points or 1%, right? The yield on the 10-year minus the yield on the 2-year. Why does this matter? I'll tell you why it matters. First thing to keep in mind is that it's unnatural, if you will, for long-term government bonds to yield less than short-term government bonds. In other words, if I'm going to lock up my money by lending it to the US government for 10 years, I should get paid more. I should earn a higher return, a higher interest rate for lending that money to the US government, which is what you're doing when you buy a 10-year US government bond, for 10 years as compared to lending the money for the government over 2 years. I mean, that makes just logical sense, right? If a lot of things can happen over the next 10 years, inflation could skyrocket, as some of the people on that first slide I showed you are predicting. Interest rates could plummet, and therefore the value of the bond could go up a lot, or interest rates could go up a lot over the next 2 years, and therefore the value of that 10-year US government bond that I'm holding would go down because the yield on that bond is lower than the prevailing yield in the market. So a lot of bad things could happen over the next 10 years. There's a lot of unpredictable things that can happen over the next 10 years, which shouldn't be the case, which is less so the case over the next 2 years. So I should be compensated more for locking up my money for a longer period of time at a fixed interest rate than over a 2-year period. So it should be that long-term government bonds yield more than short-term government bonds. When is that not the case? Well, it's really due to manipulation, right? It's due to the actions of the Federal Reserve. In effect, the Federal Reserve controls the yield on short-term government bonds. So, 90-day T-bills, Treasury bills, out to 1 and 2 year bonds. Because the Federal Reserve can push up or down short-term US interest rates, and the yield on a 2-year government bond is going to be very sensitive to what the Fed is doing right now. In contrast, historically, the market has controlled the yield on 10-year and 30-year US government bonds because what the Fed does over the next 12 months is less important than long-term expectations for inflation, for US economic growth, etc. So when the yield curve is very flat, or what we call inverted, meaning that short-term yields are high or higher than 10-year US government bond yields, that means, generally speaking, that the Fed has pushed up short-term interest rates Yet market expectations are that growth, inflation are going to come down in future, and that interest rates will ultimately have to come down. So an inverted yield curve, or a very flat yield curve, has tended to be a very strongly correlated to the US economic cycle. When the yield curve inverts, or gets very flat, you can bet that the US economy is at higher risk or rising risk of entering a downturn, a recession. So a lot of people worry about the shape of the yield curve, and they should, but I'll tell you a little bit in a minute why. Again, I think a lot of investors are taking the message from the yield curve and misinterpreting it, just as they are about stock market valuations. Here's the current chart of the slope of the yield curve. And you can see that the difference between 10-year US government bonds and 2-year US government bonds is about 0.205%, or we'll call that 20.5 basis points, basis point being 1/100th of a percent. Now that is down from about 80 basis points as recently as February of this year. And it's down from close to 100 basis points, or 1%, in the summer of last year. So the yield curve is flattened. Short-term US government bonds yields have been rising, mainly because the Fed has been raising interest rates. At the same time, the yield on 10-year US government bonds has really struggled to move far above 3%. So the gap between 10-year US government bonds and 2-year US government bonds is much lower than it was a year ago. The last time that US government bond yields were this, the yield curve was this flat, would have been back in 2007, right before the big 2007 to 2009 financial crisis and economic downturn, stock market crash, all those bad things. So a lot of people are saying, okay, the yield curve has gotten very flat. Back in August, it actually dipped below 20 basis points for a period of time. You know, the US economic expansion, the US stock market expansion must be about to die. That is not true, as I'll show you here in just a minute. But before we get into that, I want to talk about why does, and so these are all basically risks that you've probably heard a lot about over the last few months. Let me talk about something else though. I think there's a misconception out there that just because the bull market's old, just because the economic expansion is old, that it must be about to die. That is not how business cycles work. I've analyzed business cycles literally going back to the 17th century in Holland. And what you find is that the business cycle does not die of old age. And in some ways, the US economy today is actually much younger than it looks. And this is why. What I've done here is I look back to all the US economic expansions since 1949. And I plotted the cumulative growth in real gross domestic product, or GDP, which is just the size of the economy. Real means that these numbers are adjusted for inflation. And I've plotted them on a time series here. So you can see that these economic expansions lasted as little as 11 quarters or so, to as long as 40 quarters. The expansion that started through the 1990s, and this is the economy we're looking at, not the stock market. Economic expansions, and you can see that I've labeled the one from 2009 to the present. Now, in June of next year, that economic expansion will turn 10. Because it started in June of 2009, so June of 2019 will be 10 years old. But at the time I created this chart earlier this year, it wasn't. It obviously was younger. We're now up to 9 years of economic expansion, so 36 quarters. But if you look at this chart, you'll see that over this, and when I made this chart, it was 34 quarters. But the U.S. economy had only grown about 20%. Between June 2009 and the beginning of this year. It had only grown 20%. So even though this economic expansion is one of the three longest since 1949, it's actually now the second longest since 1949, surpassed only by the economic expansion from 1990 to 2000. So even though it's a very long economic expansion, it has not been a particularly good economic expansion. the US economy has not grown very much. It's only grown about 20% over this time period. In fact, if you look back there, you'll see that several prior economic expansions actually grew more, the economy grew more than the US economy has in this expansion, even though they were less than half, and in some places close to a third of the length of the current expansion. So even though the US economy has been growing for a long time, we haven't seen a recession. It's been a very lackluster period of economic growth. I also would like to point out that the measurement of US economic downturns, recessions versus expansions, is generally, typically most economists look at data provided by the National Bureau of Economic Research, where they post actual dates of business cycles. So when did the economy trough out, and when did the economy peak, and how long were recessions, how long are expansions? And that is in fact the data that we're looking at right here, based on those National Bureau of Economic Research data points. And this is you can find these on the internet, and this is sort of seen as the official or semi-official arbiter of US business cycle dates. However, there is some subjectivity here. You might have heard this old rule that two consecutive quarters of negative economic growth constitutes a recession, and 4 or more, I think some people will tell you, is a depression. That's maybe a rule of thumb you've heard, but that's not what most economists look at. They usually look at what NBER, National Bureau of Economic Research, publishes. And NBER bases their decisions on a lot more than just GDP. They look at the labor market, they look at manufacturing activity, they look at the housing market activity. It's a much more comprehensive measure of when those business cycles start and stop. But there is a degree of subjectivity. There are people actually voting on whether, the economists actually looking at the data and voting on whether it's actually a recession or not, when it started, when it stopped. And if you go back to the second half of 2015 and the first half of 2016, in many ways, the US economy almost slipped into recession back then. A lot of the data I look at, like leading economic indicators, which I'll show you here in a minute, indicated that US economy was at very high risk of entering recession. We saw economic growth really stall out. It was actually negative for a couple of quarters during that time period. And the stock market pulled back something like 19.4%, I believe, from high to low, which is almost meets the definition of a bear market. So it was very, 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 very close to a recession at that time. And if you go back to 2011, 2012, you'll also find some periods where the US economy, even though it never technically entered recession, came very, very, very close. Those soft patches were so soft, if you will, that you could almost classify it as a recession, even though it's not officially a recession. And that's reflected in this chart that you see on your screen. Even though this has been a long expansion, it's been very lackluster in terms of the pace of economic growth. And let me tell you one more thing that makes this chart even worse, if you will. And that's that there's an old rule of thumb that, I mean, it's probably been taught to business school students for, well, I know at least as long ago as I was an economics and business student, but probably even longer than that, that when you have a severe economic downturn, the recovery from that downturn will usually be sharp as well. So in other words, when you have a mild recession, the snapback to a trend rate of economic growth is going to tend to be relatively mild. When you have a severe downturn, the snapback is going to tend to be relatively powerful. And history has certainly borne this out. Some of you probably remember the recession of the early 1970s, which was very nasty and was one of the longest recessions outside the Great Depression, of course, in the US. But the snapback, the economic growth coming out of that recession, there were a couple quarters where the US economy grew at more than 10% annualized on a real basis. So the snapback was also very strong. The post-war recovery, kind of coming out of the out of the Great Depression, was also very strong because that downturn had been particularly severe. The credit crunch and economic downturn from December 2009 up until the middle of, December 2007 up through the middle of 2009 was arguably the worst economic downturn in the US since the 1930s, and certainly since the early 1970s, yet the recovery from that downturn was also one of the weakest in US economic history. So even though it was a nasty, nasty, nasty recession, and a lot of people back then were calling for a more rapid snapback in economic growth because it was such a bad recession, and typically you do see a strong recovery from bad recessions. It really was not. It did not follow the normal course. So even though the US economy has been in recovery for 10 years, it hasn't grown very much since the middle of 2009. It's been a pretty poor economic recovery. And as a result, a lot of the excesses that tend to build up late in an economic expansion, and I'm talking about things like accelerating inflation. I'm talking about things like labor market inflation, where the unemployment rate gets so low that wages spiral to the upside, which we saw many times back in the 1970s. That hasn't happened in this cycle. Indicators of corporate leverage, in other words, how much money companies are borrowing in the S&P 500, hasn't grown as much as you would normally expect at this stage of the cycle. Even consumer credit markets aren't as stretched as they have been near the end of past US economic expansions. So, in effect, even though this is a very long recovery, it has not been a very powerful recovery, and we have not yet seen the excesses in the economic cycle that we would typically see towards the end of a boom, an economic boom. As I said, and this relates back to that as well, as I said a little while ago, the yield curve has become very flat. And there are a lot of people out there saying, well, you know, that's yet another sign that this economic expansion is nearing its end. The yield curve usually gets really flat right at the end of an economic expansion. But I would point out that there's still a lot of room for the yield curve to flatten further from where it is today, and in fact remain flat for a long period of time before the US stock market tops out and the US economy enters another recession. I'll try to point this out on this slide for you. This is the 2002 to 2007 US economic expansion. The US economy entered recession in December 2007. The stock market peaked out in October 2007, so just a few months before the US economy entered recession. This is the slope of the yield curve over that entire time period. And as I mentioned on a few slides ago, the current yield curve slope is about 20 basis points, 0.2%. The first time the US yield curve flattened to 20 basis points in the 2002 to 2007 economic cycle was here in 2005. So I'll try to highlight that. Hopefully you can see where I'm highlighting. And again, that is more than 2 years before the US stock market peaked out. And it's about 2.5 years before the US economy entered recession. Look how the US yield curve remained very flat all the way up until the middle of 2007, in fact, at the end of that economic expansion. It was actually on either side of zero. So the yield curve actually got inverted for the first time in late 2005, about 2 years before the US economy entered recession. So in other words, you shouldn't be too worried about the yield curve flattening anyway, because typically it really flattens in earnest a couple of years before the economic downturn actually is upon us. If you look at the 1990 cycle, the yield curve first reached 20 basis points actually way back in 1994, where I just highlighted there. It was very flat from roughly the middle of 1997 all the way up till the beginning of 2000 when it actually inverted. And it didn't actually turn positive again until 2001. So the yield curve first reached 20 basis points of slope in 1994. The stock market didn't top out until almost 6 years later. And the US economy didn't enter recession until 2001, almost 7 years after the yield curve first reached a level of about 20 basis points. So my point is that just because this has been a long economic expansion, just because the yield curve is getting flat, none of this means that the rally is going to be over tomorrow. Just because the stock market is highly valued right now does not mean that we're going to enter a bear market this year or even next year. It could be, and in fact, I think it will be, quite some more upside to go for the stock market because of cyclical factors I'm going to outline here in just a minute. So with all of this, sort of confusion out there. With all of these indicators out there that everybody talks about without cessation at all, whether it be the yield curve, whether it be all those forecasts I showed you from the likes of Goldman Sachs, Morgan Stanley, JP Morgan, Societe Generale, Ben Bernanke, etc. With all those confusing data points out there, with the latest headlines and tweets about trade wars, etc., I think that what you need to do is you need to develop a list of indicators that you follow that have a long track record of being able to tell you where we are in the cycle and what likely is ahead. They want indicators that will tell you about the health of the stock market, about the health of the US economy, and have reliably shown us that health over many decades. Otherwise, if you don't have some indicators that you focus on, you're going to get information paralysis. You're going to get confused by the absolute avalanche of information to hit the stock market, to hit about the global economy every single trading day, every single week. If you don't focus on some reliable indicators, it's very easy to get confused. And economists are famous for this. I was trained as an economist, and one of the things I learned from that was that a lot of economists have their own pet indicators of the stock market or of the economy, usually labor market, whatever. Even guys like Alan Greenspan, who was Fed chair for a long time, as many of you know. And the problem is that a lot of these indicators sort of make their way out into the narrative on the financial media. And people get confused because you can always find some indicator out there that's pointing to a recession and some indicator that's pointing to a boom. And it seems like every time you turn on the news, every time you read your email inbox, you're going to find one guy professing the indicator that's saying we're going to enter the next Great Depression, and yet another guy over on the other side talking about how next year economic growth is going to be 5%. And it's just insane. You need to focus on just a handful of indicators that have a long track record of success, not the news of the day. There is so much, if you will, background static, white noise, whatever you want to call it, in the financial markets these days, more so than I've ever seen in my career, because the financial news cycle has become literally 24 hours a day, 7 days a week, no holiday. One of the indicators that I've focused on now for well longer than 20 years, something I wrote about in my first book back in 2005, is the U.S. Leading Economic Index. It's an indicator that comes out monthly from the Conference Board. You can actually find it for free on the internet at their website, conferenceboard.org. It literally has 10 components. And those 10 components in the LEI cover every aspect of the economy you can imagine. Everything from the labor market to manufacturing activity to the stock market to credit market conditions. They cover every single element of the stock market, every single element of the economy, rather, that you can imagine, including the yield curve, which I showed you just a minute ago. And again, it comes out every month. And I think it's one of the most valuable, sort of easy to read, unambiguous indicators of the health of the US economy that you'll encounter. I look at it in a number of different ways. I look at LEI data in a number of different ways. In fact, there are 4 different components of this indicator in a 10-point bear market checklist that I've developed with my colleague Roger Conrad in Deep Dive Investing. This 10-point bear market checklist is something we developed to do just what I told you about. These are 10 indicators that have a long history of success, predicting or forecasting or warning about, however you want to look at it, about a U.S. economic downturn and a U.S. stock market bear market. LEI, different components of LEI actually make up 4 of those 10 bear market checklist indicators that we follow. And I'm going to talk about 2 of them today. The first one is to look at monthly changes in LEI. So the month over month or sequential change in LEI. And again, it comes out every month. You can find this for free online. And this indicator, this version of the indicators is really very simple. All I do is I look at the last 6 months of data for LEI, and I count how many negative readings there are. If there are 3 or more negative readings for LEI, in other words, the month-over-month change is less than 0, then the US economy is at above average risk of an economic downturn. We looked at this data going back to the 50s when Conference Board started publishing this data, and we found that 3 of the past 6 months, negative readings on 3 of the past 6 months, has a very good track record, not perfect, but a very good track record of pointing out elevated risk of a US economic downturn. And when I say it has a very good but not perfect track record, it actually has forecast every one of the recessions in the US since the 50s. However, it's also forecast some economic downturns, which turned out to be just temporary soft patches, not a full-blown recession. So it's a very good indicator to look at. And if you do see 3 of the last 6 months being negative, you should have your antenna up for a soft patch in the US economy or possibly a recession. Right now, of course, the LEI, the month-over-month change in the LEI has not been negative since the second half of 2016. So it's been 2 years since we've seen a negative reading on LEI. So this is certainly not, at the moment, forecasting anything like rising risk of recession. And typically, it has a good track record of predicting recession 6 to 12 months in the future. And we see no risk or very little risk of a recession 6 to 12 months from now, because LEI is showing quite the opposite. It's actually showing that, as I mentioned earlier, the US economy went through kind of a nasty soft patch back here in 2015 and early 2016. You can see a number of negative readings in the month-over-month change in LEI. Since the middle of 2016, though, we've seen a steady kind of march higher in the LEI data, and lately it's been kind of at a high level, which I've circled here. So LEI is pointing towards a strengthening US economy or a fast-growing US economy, not an economic downturn. Until we see that, at least 3 of the last 6 months being negative, it's hard to predict that the US economy is nearing recession or that the US stock market is nearing a peak. Here's another indicator within LEI, and this is the LEI diffusion index. And basically, I told you there are 10 components of LEI, and those components can either add to LEI, subtract from LEI, or be neutral to LEI. And so the diffusion index just says, okay, if they add to LEI, that is plus 10. If they subtract from LEI, that's minus 10. And if they are, that would be 0. And if they are neutral for LEI, that would be plus 5. And you add up all those. So in other words, if the reading is 100%, it means that every single component, all 10 components of LEI, are adding to the index or indicating a stronger economy. If the diffusion index is 0, that means that all of them are subtracting from LEI. If it is, in this case right now, it's at plus 95%, which basically means that 9 indicators are adding to LEI right now in the most recent month, and 1 is neutral. So basically that means that virtually all the indicators within LEI are adding to the index. So not only is the LEI looking strong, the US economy looking strong, but it's broad-based. As I said, LEI has 10 indicators in it that cover everything from labor market conditions to the stock market. And so the expansion is broad-based. What you can see here, the warning sign I look for is when you see a clustering of diffusion readings below 40%, below 40 on this chart. That is typically an indicator that there's rising risk of recession. So you can see that back here. Let me draw a line. I'm sorry about my terribly not straight line here. But you can see back in 2007, 2008, we saw a clustering of readings under 40. And that was, again, another sign that the US economy was at risk of a downturn. We saw the same thing, as I said, in late 2015, early 2016. But today and lately, we've seen very few readings even under 50%, and most of the readings have been over 80%. So again, a sign that we are not at risk of recession right now, not over the next 6 to 12 months, and there's probably more upside for the stock market. One more indicator I want to talk about today that's in our bear market checklist has nothing to do with the economy, but it has to do with the stock market itself. Historically, the stock market peaks out before the economy enters a recession, and most stocks in the stock market peak out before the stock market indexes themselves peak out. Now, what do I mean by that? Well, the S&P 500 is a market cap weighted index. So the 10 largest components, names like Apple and Amazon, account for an outsized portion of the index. So if Apple goes up and the smallest 100 stocks in the S&P, if Apple goes up 5% in a given day, and the 100 smallest components in the S&P 500 go down, all of them, by 5% in one day, the fact that Apple went up is probably going to counterbalance all of the 100 smallest components, because the 100 smallest components have about the same weight as Apple. So what that means is the stock market can be going up, but most US stocks can be falling. They just might be small and mid-cap stocks that aren't particularly heavily weighted in the S&P 500. Historically, what we've seen is that the stock market kind of peaks out in stages. So what you'll see is that during the middle of an advance, most stocks, most sectors are trending higher. But as you near the final year or so, 12 to 18 months of a stock market rally, you'll start to see individual sectors of the stock market drop like flies. So you'll start to see, maybe retailers peak and start to fall, even though the stock market continues higher. And then you might see small cap stocks peak out and fall. And then you might see financials, et cetera. It'll develop like that. And one of the measures of that, we call this market breadth. And one of the measures of that we like to keep an eye on is the cumulative advance decline line for the New York Stock Exchange. All it is that on a given day, we count the number of stocks that are going up on the New York Stock Exchange, and we subtract the number of stocks going down, and we add that number to the prior day's total. In short, when this line is rising, it means that more stocks are going up in general than are going down on any given day. So typically what you'll see is the advanced decline line find a peak and fall before the S&P 500 peaks out and falls. So one of the things we want to look for is divergences between this. So if the stock market's going up, but the advanced decline line is going down, that is a very strong indicator that the US economy is at risk of falling into recession and the stock market's going to fall into a bear market. We're not seeing that right now, of course. Here's the January peak for the cumulative advanced decline line. It remained under that level for all the way up until May. So from late January until May, the advanced decline line remained below its all-time high. But since May, it's been trending strongly higher. And that's one of the reasons why we've been forecasting all year that the correction we saw back in January and February was a short-term thing, not the beginning of a bear market. And you can see that the strong uptrend in the market breadth here suggests, again, more highs for the stock market. And it suggests that the market is not yet worried about the economy as well. So that's another indicator in our 10-point bear market checklist. Unfortunately, I don't have time on this video to go through all 10, or I'd have you here until 5 o'clock in the afternoon. I do want to take some time to get to questions, but if you have any questions about it, I'd be happy to answer them during the Q&A period. So all of that brings me back to this point. So if there's one thing from a big picture standpoint to take away from today's presentation, it is this. You hear a lot of talk about the stock market being very expensive. The stock market is very expensive. It's more expensive than in 97.7% of all months going back to January 1881, using that Shiller PE ratio that I mentioned. You hear a lot of talk about the yield curve being very flat. The US yield curve is very flat. It may even invert over the next 6 months. I think that's quite possible. Typically, that is a strong indicator that the US economy is entering the latter stages of an expansion, and the stock market is getting closer to a peak. I showed you all the quotes you've been hearing lately about everybody talking about 2020 being the year where we'll see the next US economic downturn, where we'll see the next bear market for the stock market. We talked about debt a little bit. We talked about all those indicators out there that people have been referencing, pointing to the potential for the stock market to be entering a bear market or near a bear market. We talked about the length of the expansion, the length of the rally in the stock market. However, all of these indicators are really talking about longer-term stock market returns. The valuations have almost zero correlation to 1 and 2 year stock market returns. As I showed you, the yield curve always flattens at this stage of the cycle. And in fact, sometimes it's inverted more than 3 or 4 years before the US economy enters a downturn, and more than 2 to 4 years before the US stock market peaks out. So the stock market can see very strong gains even with the yield curve near zero, flat, or even inverted. All of these indicators that I think get so much attention on the news are generally longer term risks. And what I hear a lot of investors saying is, well, maybe I should sell out of all my stocks and go to cash because I'm worried about the stock market being very expensive, because I'm worried about the yield curve being flat, etc. Here's the thing though, stock market gains are often the strongest of the entire cycle in the last 2 years of a bull market. This is a chart that's based on all 12 stock market rallies, all 12 bull markets for the S&P since 1937. And I've just created a composite indicator. It only includes prices, not dividends. And the horizontal axis is days. So day 0 would be the absolute top in the bull market, and day -500 would be about 500 days before the peak in the bull market, which is about 2 years. And day 250 would be 250 days after the end of the bull market. And what you can see here is that on a price-only basis, the stock market typically returns nearly 50% in the final 2 years, on average, 50% in the final 2 years of a bull market, excluding dividends. If you include dividends, it's closer to 60%. So some of the strongest gains happen in the last 2 years of a bull market. In the last 1 year of a bull market, on average, since 1937, the S&P 500 has returned about 25%, including dividends. If you miss out on that final melt up, which has ended virtually every bull market you will find, not only in the US, but all over the world, that final melt up rally, if you miss that, you're giving up as much as 40% of the entire gains from the full bull market. You cannot afford to miss out on 58% of upside over 2 years and expect to beat the stock market over the long haul or even over a short period of time. In fact, you're better off selling stocks about 3 or 4 or 5 months after the peak than you are selling out more than a year before the peak. I know we've all heard the expression, the early bird gets the worm, but in the stock market, the early bird actually starves. The bird who shows up a little late gets more of a reward than someone trying to be too anticipatory about the stock market and the economy. And with that, I would say it's very important to separate long-term from cycle. The long-term valuations is all that matters. In the short run, it's where we are in the economic cycle. The economy is like an organism. It has an early lifespan. A bull market has an early life. It has a middle ages, and it has an old age. And each of these parts of the cycle have different characteristics. I believe that we are entering the latter stages of this rally, but that could mean another 2 years of upside for the stock market. It could mean another year of upside for the stock market. But that upside, I believe, is going to be rather large before we actually reach the peak of this bull market. What you must do if you want to beat the market over the long haul is to establish a set of indicators that can tell you where we are in the cycle and what the cycle is saying about stock market returns, about stock market valuations, and about what sectors and stocks you should be buying and what sectors and stocks you should be selling. We believe our 10-point bear market checklist, I told you about, excuse me, 3 or 4 of the indicators that we use there on today's presentation. We believe it's a very good one for telling where you are in the cycle. And it's certainly one based on evidence that we've assembled going back many decades. But even if you don't use that, even if you just use the 3 indicators I showed you, it's very important to have something that you look at, something reliable that you look at, something with a long track record that you look at to understand where we are in the cycle. So please, even if you don't look at our 10-point bear market checklist, just keep an eye on things like LEI and use it as a filter for all the white noise and static you hear in the financial media, which I believe confuses an awful lot of people. And no surprise there, because it seems like every time they throw up one of those octo boxes with 8 different analysts talking about the economy and the stock market at the same time on financial television, it seems like there are 8 different opinions. So I promised in the beginning that I would talk about a few of the names we like and have liked in deep dive investing since we launched the newsletter in March of 2017. So it's about a year and a half old now. One of our favorites, which we first recommended in May of 2017, is United Rentals. The symbol there is URI. URI trades in the New York Stock Exchange. This company is an industrial company. And industrial stocks are often the most correlated to the economic cycle of any sector of the S&P 500. So in other words, when the US economy is strong or getting stronger, industrials are a great sector to look at. They are very pro-cyclical. And in fact, our industrials picks have beaten the market since May of 2017 by almost a 2-to-1 ratio in terms of percentage returns. One of our favorites in May of 2017 was United Rentals. We recommended it, believe at first around $106 a share, and we recommended adding to the position around $115 a share. It got all the way up to $190 a share earlier this year, and it pulled back. And just over the past few days, we've seen it break higher again. And one of the things we like to do in deep dive investing is it's not just about telling you what stocks to buy and when to buy them, but we also like to give you advice on how much to invest in each of the recommendations, when to add or sell some of that position to either take some profits off the table, control risk, or position yourself for further upside. And we recently recommended adding to the position in United Rentals because we think that the stock is due for another run-up. Let me explain to you in very brief what the fundamentals are. This company is in the equipment rental business. You may have seen this company's equipment. Next time you're out on the highway and you pass by a construction, either a government construction of a road or someone building a commercial building, look at the cranes and the scaffolding and all the equipment on the job site. And it's quite possible you'll see United Rentals equipment there. What they do is they own a bunch of backhoes and tractors and all sorts of equipment used in building, also used in things like building refineries, building various facilities. Even, in fact, they lease a fair amount of equipment in Silicon Valley used to build things like Apple's headquarters in Silicon Valley. So they serve a wide variety of industries. And what they do is they lease that equipment out to the construction companies, the companies that are building things. And they do that for a rate, a daily fee or a monthly fee. United Rentals is the largest equipment rental company in the United States. Yet, even after a series of acquisitions this year, they only control around 15% of the market. It's a highly, highly, highly fragmented market. There are a lot of regional sort of mom and pop, if you will, equipment rental companies out there. They control, there are really only 2 main dominant players. One is United Rentals, has about a 15% share. The other one is a company called Sunbelt Rentals, which is actually owned by a British firm called Ashdeed. And they have around a 9% market share. So even the 2 largest players together have less than a quarter of the market. United Rentals is a consolidator. They're buying up a lot of these smaller regional mom and pop chains, and there are huge economies of scale in the equipment rental business. Let me give you a few examples. If you're a national construction firms, and a lot of them are national construction firms, would you rather deal with one company for all your equipment rental needs, or 37 small companies located in different states around the US? Chances are you'd rather deal with a large company. Large companies also have economies of scale for maintenance, for being able to move equipment from one state to another to meet short-term demand in one state versus another. So there's a lot of economies of scale, cost cutting that can go on when they buy up a smaller competitor. The other thing is that equipment rental is becoming a much more popular way of owning equipment. In other words, a lot of construction firms historically have owned some of their own equipment. But they're finding that their costs are lower by leasing that equipment and then turning it back into the equipment rental firm when it's no longer needed, and then leasing new equipment in another part of the country where they have a new project, rather than owning the equipment themselves and being forced to move it from place to place to place as they move from one project to another. This is a growing business. Rates for leasing equipment are going up because there's an imbalance between supply and demand. The demand for new construction is rising faster than the supply of equipment right now, and so lease rates are going up. So United Rentals has done very well for us, and we think that the positive response, the rally over the last few days, in a response to yet another acquisition made by the company, is a sign that it's getting ready for another leg higher. We're recommending that you buy United Rentals. Right now, our buy under target there is 170. It's trading a little under that right now. We think ultimately this stock could get up to $230 to $250 a share over the next 6 to 9 months rather. So that's one stock that we like right now in deep dive investing. We also believe that telling you what to sell is just as important in many cases as telling you what to buy. Everybody wants to talk about what stock should I buy now? What stocks or ETFs should I buy now? But it's just as important to know what not to buy, what not to get caught up in, because a few bad eggs can kind of sink your overall returns. One of the things that we've also found, even in this era where ETFs and buying sectors have become so popular, is that there is a huge amount of upside available to those willing to be more selective and actually do some stock picking. And historically, the importance of stock picking, of picking individual stocks as opposed to sectors or just buying a market index fund, becomes more important in the latter stages of an economic cycle, just when historically passive index type strategies become most popular is when you should run from them. We found that being selective about the stocks you buy can really add a lot to your returns. One of our biggest winners in deep dive investing over the last year has been our recommendations in the regional banking industry. Regional banks, smaller, mid-sized banks, tend to perform best when short-term interest rates are rising. The reason is that if a bank has loans on its books, if they have a lot of floating rate loans, loans that reprice as interest rates rise, then the amount of interest that they charge on their outstanding loans goes up whenever the Fed hikes interest rates. Unfortunately, a lot of people have been trading this by buying the regional banking ETF. And I still have received a couple of emails and calls over the last year saying, why do you recommend the regional banks? The regional banks have been underperforming the market. Well, the regional banks have been underperforming the market only if you look at the regional banking ETF or the regional banking index. There are several regional banks out there, one of which I'll tell you about in a minute, that are performing way better than the stock market, and certainly many times better than the regional banking ETF. And that's because they are the ones that are actually beneficiaries of rising interest rates. As I said, banks that have floating rate loans see those loans reprice as interest rates rise, and therefore they benefit from rising interest rates. Banks that have a lot of fixed rate loans on the books, mortgages, multifamily residential mortgages, they do not benefit from rising interest rates because the rates do not rise when short-term interest rates go up. In fact, in many cases, such as the case of New York Community Bank Corp, symbol NYCB, which is a name we've said to sell now for well over a year. New York Community Bank Corp has one of the highest dividend yields of any bank in the regional banking index. In fact, I think it's the highest of any bank in the regional banking index. And therefore, I think a lot of investors gravitate to it because they want to earn that dividend yield. The problem with New York Community Bank Corp is about 3/4 of their loans are multifamily residential loans. In other words, residential loans to people who own apartment buildings in the New York City area. Typically, multifamily residential loans carry a fixed interest rates for the first 5 to 7 years of the loan, and then the interest rate floats thereafter, which means that New York Community Bank Corp does not benefit from rising interest rates in the short term because a lot of their loans carry fixed interest rates for the first 5 to 7 years of the loan term. And guess what happens, right? When interest rates are falling, people who have multifamily residential loans tend to refinance those loans to take advantage of lower interest rates and to lock in lower interest rates. When interest rates rise, in contrast, they sit there and enjoy those low fixed interest rates for 5 to 7 years. So this is actually a very tough business when interest rates are rising. In fact, New Bank Corp actually is harmed by rising interest rates. That's because the New York market is a very competitive market for deposits. And because a lot of companies need to raise deposits to support their loan books in the state of New York Community Bank Corp has to try to attract depositors, which they do by offering very high interest rates. In fact, New York Community Bank Corp's loan to deposit ratio, in other words, the total value of their loans divided by the total value of their outstanding deposits, is the highest of any of the 74 banks that we analyzed in deep dive investing. Therefore, they really need to raise deposits, and raising deposits in the state of New York is expensive because you have a lot of different banks competing for depositors by offering very high interest rates. In contrast, in other markets like Texas, for example, the deposit market is much less competitive regionally, so banks don't have to pay up to their depositors to attract additional deposits. So New York Community Bank Corp, example of a name that we recommended selling. An example of a name that we recommended buying has been Comerica, symbol CMA. This regional bank based in Texas has a lot of commercial and industrial loans which carry floating rates. Floating rate loans accounts for over 80% of their loan book, meaning they're one of the biggest beneficiaries of rising interest rates on the lending side. On the deposit side, the Texas market is a lot friendlier for banks wanting to raise deposits than the Northeast, and in particular the state of New York. We've picked a number of financials in deep dive. Since we first started recommending them back last year, as I said, our picks are up 21.01%. The S&P 500 over an equivalent holding period is up about 13.75%, and the regional banking index is up 9.75%. I didn't put the slide up to boast or brag. I put this slide up because I want to show you that stock selectivity, stock picking, whatever you might have heard out there, is actually very important. And it's frustrating to me because I often get pushback when I recommend the regional banks from people saying, regional banks are not performing as well as the stock market. And you can see on that slide, that's true if you're only looking at the regional banking index or the regional banking ETF out there, which is indexed to the KBW regional banking index. They are performing not as well as the S&P 500. But if you're selective and you avoid names like New York Community Bank Corp that have negative exposure to rising interest rates, and you focus on names like Comerica that benefit from rising interest rates, then you're looking at a very different picture. We've actually outperformed the regional banking index by a factor of more than 2 to 1. So that's it for my prepared slides right now. I do want to move into a Q&A session next. If you have any questions, please type them into the Q&A box on your screen or the chat box on your screen, and I'll answer them right here on today's webinar. As many questions as I can get to, which is probably all of them. Before we get into the Q&A portion of today's the webinar, I do want to say that we are offering a special risk-free trial offer for deep dive investing. In my opinion, it's the best offer we've made on this service since last year. And I'll tell you why. We are offering a 60-day risk-free trial for deep dive investing. That means that if you decide to take us up on this offer and you subscribe, you can cancel at any time in the first 60 days of your subscription, and we will give you a full 100% money back with no questions asked, and of course, no hard feelings. 60-day risk-free trial, absolutely risk-free trial. You know, I know a number of our competitors that charge restocking fees. I'm not sure how you restock electrons for an online service like this, but they charge a restocking fee. We do not charge a restocking fee. It is literally a 60-day risk-free trial. Give us a try. Try it out for 60 days. If you decide you don't like it for any reason, if it's not for you, no problem. It's not for everyone. We will give you a full 100% money back. In addition, we will start that 60-day trial next Friday, September 21st. So not this Friday, not tomorrow, but a week from tomorrow, regardless of when you take us up on this offer. So if you subscribe this afternoon, your 60-day risk-free trial will start September 21st. And if you subscribe on Sunday, it'll still start on September 21st. You'll have immediate access to the newsletter, but your risk-free trial period will start. The clock on that 60-day risk-free trial will start ticking on September 21st. Why are we doing that? Well, we found in the past when we offer these risk-free trials, we have a deluge of people signing up in the last few hours of our offer. And it kind of overwhelms our subscriber services department, which consists of our subscriber services manager, Sherry, who many of you probably talked to. So we're taking that off the table. No matter when you sign up, your 60-day trial period will start a week from tomorrow. So that gives you a few extra days, in fact. You could call it maybe the 68-day risk-free trial. In addition, this is something we've never offered before on any of our newsletters before this. We're offering our subscriptions on a prorated basis. Prorated basis. After your 60-day, or in this case 68-day trial period, you can still cancel deep dive investing, and we will give you a refund for your unused months of your subscription term. So in other words, if you decide that, you know, after 6 months that you no longer wish to receive deep dive, you know, maybe your needs have changed, maybe you find you just didn't have time to read all of what we send you and listen to all the videos that we send you, you're perfectly welcome to cancel at that time, and we will give you a refund for your remaining subscription term. So in that case, the last 6 months of your subscription term. In addition, these subscriptions come with their forever guarantee, which means that sign up today. If you decide to stick with us and a year from now you decide to renew, you will be renewed at this subscription rate. We will not raise your renewal rate. I know if you're like me, you subscribe to newsletters in the past, services in the past, and you know, you get that nice upfront cost of, you know, one rate, and then they go to renew your subscription a year later and they charge you twice that much or 3 times that much. I've certainly seen that many times in the past. We do not do that. Your subscription terms are locked in from the time you sign up. So in other words, sign up today, a year from now, we will ask for the same price and we will extend the same terms. You'll have that prorated subscription guarantee if you choose to renew forever. The current price for deep dive investing is $1,500 annual. And again, that's 60-day risk-free trial and prorated. The only way you can sign up for this offer, we're only offering this to a limited number of people, less than 1% of our subscriber base, and we are also only offering it for a limited time. If you click that link or go to that link that's on your screen, that is how you can ensure that you will receive all of the bonus reports that I mentioned on today's webinar, as well as on that webpage, and make sure you get that prorated guarantee. Alternatively, you can give our customer service manager, Sherry, a call on the toll-free number on your screen, and just tell her that you are part of the VIP webinar offer to make sure that you get signed up at this rate and on the prorated basis. We've never offered prorated subscriptions before in the past because for a company our size, they create an awful lot of accounting headaches, if you will, and an awful lot of headaches for our customer service department. That's why we are only opening up a limited number of prorated subscriptions on a test basis. I'm not sure when or if we will ever offer this again. It's something a number of you have asked for, so we're doing it on a trial basis, but I don't know whether we're going to ever offer this in the future or not. If we do, it probably won't be until next year or so when we get a better idea of how popular prorated subscriptions are and just see how it affects our customer service team. So the deadline for this offer is next Tuesday, September 18th at midnight Eastern Time, or when the 30 prorated memberships that we've opened up, the 30 prorated deep dive investing trial memberships fill up, whichever comes first. That's the special trial offer we're offering today. One more thing, which I just added to the mix today because I'd like to have as many of you as possible who are interested in deep dive give it a try. We are nearing capacity on this service. In other words, we do limit the total number of subscribers in deep dive investing because we want to have a subscriber base small enough that we can give you the personal attention that you're used to from our services. So we don't want it to get too big, and we don't want it to get too hard for us to answer your questions. So we do have a limit on the total number of subscriptions. We're nearing that limit, and we wanted to offer it, one last time at our best rate to some of our best and longest term readers, and that's why we're offering it today. To give you just one more carrot, if you will, to make this offer as much of a no-brainer if possible, we are offering 1 free quarter of Energy and Income Advisor to anyone who takes us up on this offer between now and next Tuesday. So sign up for Deep Dive Investing trial today, and we'll immediately give you a 1 quarter trial of our Energy and Income Advisor service, which many of you are familiar with, focuses on the energy markets. That's a $299 value. We'll give that to you free. If you are an existing Energy and Income subscriber, and I know that actually a majority of those of you on today's webinar are, we'll just extend your Energy and Income Advisor subscription by 1 quarter on me. So that's the offer we're offering today for Deep Dive Investing. I think it's a very good one. And now I'd love to open up the floor for Q&A. I'm going to pause here for just a second to give you time to type your question into the Q&A box on your screen or the chat box on your screen, and for me to have a drink of water so I stop coughing here. But please ask any question you'd like, and I'll get to as many questions as I can on today's webinar. So I'm just going to pause here for about 15 or 20 seconds to give you a chance to put some questions into the queue. Thank you very much. All right, everyone. Again, if you have a question that you'd like to ask me, feel free to type it into the Q&A box on your screen or the chat box on your screen. I see a couple of questions have already hit the Q&A box on the screen, so I'll get to those now. If you do have, just one more reminder, because I know I'm going to have questions about this. This webinar has been recorded in full, and I know that some of the slides might have been difficult for you to see on your screen. So I'm going to send you a link to the recording of today's webinar, as well as a link that will allow you to download the slides in PDF format. That'll be with you tomorrow morning. So keep an eye on your inbox for that. If you have any questions that come up after the conclusion of today's webinar, feel free to just drop us an email on our subscriber services, our subscriber services inbox, and we will, and we will answer them via email. So let me get started answering the questions I see here. First one is, do you believe that starting 2016, we are in a secular bull market which can last 10 to 15 years? And can you explain that after the next bear market, would the market follow the secular bull? Okay, let me give that a shot. I don't think that we started a new secular bull market in 2016. I do think that that what we saw is that the economy has grown at a very slow pace coming out of the financial crisis. And because it's been growing at a slow pace, what that's effectively done is it's added longevity to the cycle compared to historical norms. So whereas historically a 10-year economic expansion is kind of like somebody who's 120 years old, maybe. In this case, you've had an expansion which has not been on most measures, has been kind of modest. So even though it's old in terms of years, its health is like a much younger expansion or much younger person. So maybe it's a 75-year-old man instead of a 120-year-old man, just based on the actual health of the cycle. I do believe we are beginning to see some signs of latter stage bull market, latter stage economic cycle, just beginning to see them. And I'll give you a few examples. The unemployment rate is under 4%. It's extraordinarily low by any historical yardstick. Even if I look at some of the broader measures of unemployment, unemployment rates are down close to the lowest level they've been since the late 1990s economic boom. At some point, that will result in people demanding higher wages, and at some point that will feed through into higher inflation. Inflation has been ticking up ever so slightly for the past maybe year or so, but it's still pretty mild. We're starting to see it though on the commodity side a little bit more. Oil prices are obviously up a lot. The low for oil was what, 25 bucks a barrel. It's almost tripled off its low in early 2016. Inflation is something you typically see towards the end of a cycle. And also what you tend to see is that the Fed starts fighting inflation as we near the end of the economic cycle. And ultimately that brings about the end of the cycle. So this hasn't happened when it normally would, because the economy was growing so slowly. The Fed couldn't afford to hike interest rates or take away any stimulus back in 2015, 2016. Many of you will remember, they talked about hiking interest rates, and they hiked interest rates for the first time in the end of 2015. And they were talking about, at that time, they were saying they might hike 3 or 4 times in 2016. In the end, they were only able to hike once in December of 2016, a year later, because the economy was in such foul shape in early 2016 and late 2015. What the Fed would normally be doing at this stage of the cycle hasn't happened yet. The other thing is that even though the US has officially avoided recession, a lot of other major world economies have not. Europe has been in and out of recession, depending on what country you look at, since 2009, and the expansion there has been much less robust, and that's affected US companies because as much as half of the S&P 500 earnings come from outside the US. So no, I don't think we began a new secular bull market, but I would say that the existing bull market could carry on a little longer than normal, and that a lot of the calls for, okay, this is the longest rally in history, so it must be about to end, are misguided. What's going to bring about the next bear market? I would, it's always hard to tell ahead of time what's going to cause the next bear market. I can tell you that typically it's not the thing that caused the last bear market. So in other words, you had, in 2007, 2008, it was housing and credit markets basically that caused the Great Recession. In the late 1990s and early 2000, it was basically high tech. And so it's highly unlikely, in my view, that it's going to be financials and credit markets that cause the next big downturn this time around. It could be any number of other factors. A lot of people have talked about, trade being a factor. The thing, though, is that you don't need to try to anticipate that. And in fact, I think it's a mistake to do so. You can certainly highlight the risk. You can certainly sit there and say trade could be a problem for the global economy. But until we actually see it in the economic data, and I guarantee you we will see it in the economic data if it becomes a problem. We will see it in LEI. We will see it in market breadth. We will see it in that diffusion indicator I showed you. We will see it in the other cyclical indicators that we have in the 10-point bear market checklist. But until we do, it's too early to sell. The stock market historically has not topped out more than 1 year before the US enters an economic downturn. And so until we see real signs that an economic downturn is imminent, I think it's a mistake to get too aggressive on the sell side. But I don't think that we began a new secular bull in 2016. I think that we just maybe gained an extension on the current bull. The US economy growing as fast as it has been over the last couple of quarters may finally be the thing that allows some of the normal excesses to build up in the latter stages of a cycle. But as of now, we just haven't seen it yet. So hopefully that answers your question. If not, feel free to post a clarification and I'll add to that answer. Next question is, briefly, would you describe the difference between your publications? Sure. We have a number of publications at Capitalist Times, which is the parent publishing firm. We have Roger Conrad's Utility Investor, which many of you I know are already subscribers to. Roger has been covering the essential services markets now for more than 3 decades. So he covers a lot of dividend-paying stocks, higher income stocks, such as electric utilities, water utilities, et cetera, in Conrad's Utility Investor. So that is a monthly newsletter online that focuses on essential services industries and income exclusively. Energy and Income Advisor is also an online publication. It comes out twice a month. Focuses on the global energy markets. We really do cover the waterfront in terms of energy, everything from oil and gas producers to alternative energy, to master limited partnerships, which are typically involved in owning assets like pipelines and gas processing plants. And we have model portfolios that are focused on that sector. We have a model portfolio that's focused more on income, generating dividends out of groups like the master limited partnership. And we also have a growth portfolio that's focused more on total returns, both from capital gains and dividends. So that's Energy and Income Advisor. Deep Dive Investing, which is the product that's most closely associated with what I've been telling you about today. It's really our go anywhere product. We look at all different sectors of the market, and we also pay a lot of attention to the macro picture for the economy and for all the different sectors. In deep dive investing, 2 of our biggest winning picks over the last year have been some of our recommendations in the industrials, like United Rentals I showed you earlier, as well as the regional banks. So obviously we're not just focused on energy there. We do have some energy recommendations in deep dive, but it's a small part of this product, not the only part like for Energy and Income Advisor. Deep dive investing is also a little bit unique because most of the content is delivered via online presentations, similar to what you've just experienced, where Roger or I or both of us will go online and record a 60-minute presentation usually, discussing an individual sector of the stock market that we think is interesting. Sometimes we talk about the macro picture for the stock market in those issues, and then we recommend specific stocks and to buy right now. We also recently launched an active total return portfolio for which we send an update out about every 7 to 10 days, and basically, or sometimes more often when needed. But basically we tell you in that portfolio not only what stocks to buy, but when to buy them and how to buy them. In other words, add to your position in, United Rentals at this price. Take a little money off the table in, Comerica at this price. That kind of level of advice. So deep dive investing is also our newest service. It's beaten the market significantly since inception. But it's a relatively new newsletter. We launched it to a very, very small group of beta testers in March of 2017. So that gives you sort of a brief overview of those three publications. I hope that answers your question, but they really are very different. Energy and Income Advisor, only the energy sector. Conrad's Utility Investor, very much focused on income and essential services. And Deep Dive Investing is kind of our go anywhere product, our flagship go anywhere product, where we'll literally recommend, across different sectors of the market. We also in Deep Dive have a strategy for, as we feel that we're approaching the top of the stock market, that we're going to take steps to actually recommend for you to hedge your exposure to the stock market. One of the most important things to your long-term returns isn't what stocks you buy. It's how you deal with the bear markets, not how you deal with the bull markets as much as how you deal with the bear markets. If you had just, for example, back in 2007, taken half your portfolio out of the stock market and put it into, say, U.S. government bonds, 2008 would have been a great year for you instead of one of the worst years in history. So we do have strategies in place that are based on our 10-point bear market checklist. When we feel that we're getting near a top, we're going to start taking actions to hedge our portfolio, hedge our exposure in the model portfolio by recommending specific hedge positions. So that kind of gives you a little overview of those three publications. Let me move here on to the next sector. Does the peaking of the energy sector indicate that we're in the late stages of a bull market? Actually, no, quite the opposite. Energy has actually been one of the best performing sectors of the stock market so far in 2018. And that is actually normal. As I told you, I think I mentioned during the presentation that the stock market, the peak of a bull market doesn't come in one go. It comes in stages, right? Certain sectors peak out before the stock market peaks out. And some of that is purely cyclical. For example, the energy sector is what we usually call a late cycle performer. In other words, it tends to perform best in the final 6 to 12 months of a bull market and the first 6 months or so of a bear market. And let me just give you a few examples. Energy stocks performed very well from the beginning of 2007 all the way up through the middle of 2008. And actually, energy stocks reached a new high in the spring and early summer of 2008, even though the U.S. stock market, as measured by the S&P 500, peaked out in October of 2007. So energy kept running after the bear market actually started. And a lot of that has to do with inflation. I mentioned that inflation tends to pick up in the latter stages of an economic cycle. And that means that commodity prices tend to rise in the latter stages of a cycle. And so what we're seeing with energy this year is entirely consistent with that. We think that energy has been through a bear market, actually, from 2014 all the way up until 2016, 2017. And I think now we're actually in a bull market in energy stocks and oil itself, as measured by simply the fact that oil's nearly tripled from its lows, and energy stocks are among the better performing sectors so far this year. And even some of the really laggard groups like MLPs have started to turn around as well. So we think that's actually entirely consistent with the last, as I said, 12 to 18 months of a bull market. And that's actually what we're seeing right now. So when you see energy peak, the short answer to your question is the bull market's probably already over, because usually energy peaks out right at the very end of a bull market for the S&P 500 or after the broader market peaks out. So hopefully that answers that question. Does anybody else have any questions to add to the queue? If you do, go to the Q&A box on your screen, type your question in, and I'll be happy to get to it right now. Or you can go to the chat box if you prefer and ask it there. Let's see, I don't see any more questions on the line right now. So let me just pause here for a few seconds and give you a chance. If you have any other questions to ask, feel free to, I can see there are a number of you still on the call. Feel free to ask a question right now, and I'll answer as many questions as I can get to. Okay, we just had one more pop in. Asking if you're 75 years old, should one stick to the utility investor report? You know, it really depends. It's not so much about age, you know, as it is about what your investment goals and risk tolerances are. In deep dive investing, we do actually have a model income portfolio, which my colleague Roger Conrad, who runs the Conrad's Utility Investor, it runs inside deep dive investing, where he goes far beyond just the essential services sectors to other sectors of the market that offer high income. If you're interested in income, then Conrad's Utility Investor is certainly a great choice. You know, it's certainly a product that he has a very strong long-term track record with. However, there's plenty of income in deep dive investing if you're looking to move outside the essential services and utility sectors into other sectors of the market that offer income. You know, depending upon what your risk tolerances are and what level of aggression you have, I mean, it may be, what really matters to most investors isn't how they receive their return, it's their return. So in other words, if you are really looking for high current income, then Conrad's Utility Investor is probably a great way to go. If you are, however, interested in total returns, in other words, your total gains from capital gains and dividends, then you may also find some of our other services, in particular deep dive investing, of interest. In the total return portfolio, which we have as an actively managed hypothetical portfolio in deep dive, we really look for returns however we can get them. So in other words, some of the stocks that we have in there offer very strong yields. I believe that we have a stock in the total return portfolio offering upwards of 5% yield right now. At the same time, we also have some stocks that don't pay dividends at all. So we'll go wherever we can. Total return, in our view, doesn't mean that we're neglecting dividends or not paying attention to dividends. It just means that we're willing to go wherever we can to make money, to generate above market returns. So if that comes through capital gains, as it has in certain stocks like United Rentals I showed you earlier, so be it. If it comes through dividends or distributions, as it has on other recommendations we've made, then you know we're good with that too. You know, I think that it has less to do with your age and more to do with your risk tolerance and you know what you're looking for from an investing standpoint. You know, are you more interested in being a little more active and going into different sectors and generating total return, or are you really strictly interested in high current income? So hopefully that answers your question. So anybody else have any more questions, please just go ahead and pop it into that Q&A box on your screen, and I'll answer as many questions as I can get to. Also, if you have any questions after today's call, feel free to go to the website that's on your screen and you know click the Contact Us button and email me, and we'll get back to you. Or you can use our service email address, service@capitalisttimes.com, and we'll be happy to get back to you with an answer to your question. So I don't see any more questions in the queue right now. I do thank you all very much for joining us today. Certainly have enjoyed doing this call today, as always. And I think it's a really critical time of the cycle. You know, one of the things that I've looked at, being someone who's been very interested in financial history for a long time, not just what the current situation is, because sometimes I think that just looking at the current time, you know, you're kind of staring at the tree instead of looking at the whole forest. But looking at financial history over, you know, the last several hundred years, I can tell you that there are probably the two most crucial times of the entire cycle are the beginning of a bull market and the end of a bull market. Because at the beginning of a bull market, everybody's just scared, just out of control scared. You may remember back in March of 2009 or so, when the S&P 500 bottomed out, all the doom and gloom forecasts are out there. I remember writing for my prior publisher before I started my own firm back then. I wrote a piece for a free commentary that we used to send out, where I predicted that the economy would start to grow again by the middle of the year. Actually, I think I said August of 2009, and that the stock market was near a bottom and would probably be higher a year later. And I got actual hate mail emailed to me from people who were like, "No, you're saying they're green shoots, but it's not going to happen. You know, there's at least another 25 or 30% of downside for the stock market." Everybody was just scared out of their minds. But my indicators had started to point to some green shoots, and I have to follow that which has worked for me in the past and which has a long track record of success. And so that's a very critical stage of the cycle, because when you see those green shoots, it takes a lot of courage, a lot of confidence, and a lot of conviction to buy into the stock market again, because most people are going to be running the other way. And, you know, watching financial television, you know, it's kind of like watching a horror movie. Now, at the end of a bull market, it's actually, it's quite opposite. It's in some ways quite the opposite. In the latter stages of a bull market, some people are going to be ultra bullish. Other people are going to be talking about, you know, the end of the bull market, but they're going to have been talking about that for, in most cases, for many quarters. So there's a temptation to either sell out way too early or to kind of whistle past the graveyard, if you will, when the signs are already in place that the top is in. And so you need to be ready in the latter stages of a bull market to be in the right sectors, because some sectors, as I said, are already going to be going down. Other sectors are going to be in the early stages of an expansion. So you need to be ready for that. And you also need to be ready soon after that bear market starts at the latest, hedging your portfolio and protecting yourself against the next bear market. Because, you know, it can take 5 years, 7 years to recover from a nasty bear market, such as we saw in 2007 to 2009. You know, I don't have, you know, I want to make my money back. I don't want to lose so much money that it takes me 7 years to make it back. And for someone who's close to retirement, for example, you know, that can be a blow that's irrecoverable. So you have to be ready at the end of the bull market and have some indicators in place. That's why I stress so much, even if you don't like my 10-cycle bear chart, 10-point bear market checklist, look at things like LEI and just keep your eye on the end of that bull market. It's a very important time. That's why I felt it was so important to have this webinar today. I know it was kind of short notice. I know some of you are just getting back from, you know, Labor Day or just finishing up your end of summer barbecues and whatnot. You know, some of you may even be, you know, experiencing the hurricane that we're having here on the mid-Atlantic states this year. You know, I know it's not the best timing in that way, but I think it's a crucial time of the cycle. And that's why we're making this offer to you today. And that's why we're hosting this webinar today. So again, hopefully some of you will give Deep Dive Investing a try. I will send out a copy of my slides in PDF format to you by tomorrow morning sometime. Also, I'll send you a link to the recorded version of this webinar so you can go back and listen to anything you missed. If you have any more questions, I don't see any new questions in the queue, so I'm going to go ahead and end the conference for today. But if you have any questions that come up later, feel free to drop us an email. And, you know, thank you very much again for joining me today. Have a good evening, everyone.